Today, we're going to talk about how to get paid as a multifamily investor. Hey, Small Axe community, it's your boy Nico. This show is dedicated to helping you use your small axe to build a personal empire. So, on this show, I'm going to share some real, raw, behind the scenes info that's going to help you build your own multifamily portfolio. So if you enjoy this show, I would love it if you could share it with somebody that you think could get value from it and write a review. It's the only way that we can grow this thing. Now let's get to work. Let's jump into this episode and start sharpening those axes. Okay, so there are two positions or two roles that I'm going to talk about here today: the general partnership team, or the general partners, and the limited partnership, or the limited partners. You can be either one of those or both of those. I am both a general partner and a limited partner. Let's start with the general partnership team. The general partnership team is the team that's managing the property, managing the project, making sure the business plan comes to fruition. The general partnership team will first get paid an acquisition fee. The acquisition fee is typically the first payment that a general partner sees, and it might be the only payment. So listen carefully. The acquisition fee is typically anywhere from 1 to 5% of the purchase price. The bigger the deal, the lower the acquisition fee should be, technically, because if you have a $20 million deal, 5% of a $20 million deal is $1 million. And yes, it might be justifiable from time to time, but typically on a deal that size, you're going to see anywhere from 1 to maybe 3%. I keep mine standard at about 2% because typically the deals that I'm looking for are $5 million and under, and a 2% acquisition fee is not going to be that devastating to the deal. One thing you need to consider as an investor in a deal: what is the acquisition fee? How much is it? Is it worth it? And does it make sense for that particular project? Because some projects you should not be taking an acquisition fee only because the deal can't support it. So the business plan won't really support it. However, the first type of payment, acquisition fee. Let's take a simple scenario. We have a $1 million purchase. We're going to do a 2% acquisition fee. It's $20,000. That goes to the general partnership team. What is that for? Why should they get paid? Well, the general partnership team needs to get paid because they're doing a ton of work on the back end, getting the deal to the finish line. First of all, it took me 3 years to get to my first deal. Remember, 3 years of work day in and day out without getting any payment to get my first deal closed. What type of money was I putting into this? First of all, I joined the mastermind program, $10,000. Second of all, I bought countless books and countless trips to go on these mastermind retreats and to join groups and make sure I'm educating myself properly, as well as all the software and back-end things that I needed to start my business. I had to build a website, keep it going. I started a podcast, keep that going. I had to go direct to seller, pay somebody to go direct to seller for me. I have an email campaign, which I pay for. There are so many fees that go along with me maintaining a business, not even having a deal, that getting a deal to the finish line is justifiable to have an acquisition fee. 100%, I would not be doing this if I didn't get any type of fees for this. Acquisition fee. Also, getting the deal to the closing table once you get it under contract is insane, guys. I'm going to tell you, it is a couple of months of complete insanity for the most part, unless it's a smooth deal. But for the most of the deals and all the deals that I've seen, it is crazy to get to the finish line. The work involved is extremely intense. It is worth getting paid for. Okay. The next fee is once you're managing the property as a general partner, you get what's called an asset management fee. I've been foregoing my asset management fees because the cash flow has been weak the past couple of years. Henceforth, I am not getting paid an asset management fee. It's justifiable and it should be paid. So people who are charging an asset management fee, 2% is typical or standard. 2% of gross collected rents is what we value it off of. That is how the general partners can get paid. So let's say that you have 16 units, $1,000 a unit in rent. So that's $16,000, 0.02. That is $3,200. No, excuse me, $320 a month. Okay. That's where it's like, it's not real money. You're not really living off of an asset management fee. And I need to be very clear on that. Your asset management fee at $300 a month is barely keeping you afloat, maybe buying you coffee. So if you are thinking that you're going to quit your job and become an active multifamily real estate investor and be an asset manager of a portfolio of 100 units, you are not going to be surviving. Let's take simple numbers off of that. 100, let's say you have 100 units in your portfolio as an asset manager. Okay, $1,000 a month in rent times 0.02, $2,000 a month. So in order to be profitable here, in order to have it make sense, it seems if you're looking for that $10,000 a month revenue, you need 5 times this. You need 500 units minimum to get that asset management fee. So you need to be an asset manager for 500 units, collecting profitably and collecting that 2% of the gross collected rents. Not easy, guys. So don't think that right away, if you're going to quit your job, you're going to jump into multifamily, you're going to get asset management fees to replace your income. You're going to get acquisition fees to replace your income. Likely not going to happen. Next, how else do the general partners get paid? The general partners can also get paid as with a capital event fee, meaning like a refinance fee. You can charge for that as well. It could be 1 to 2% as well, maybe 1%. I have never charged for it, and I likely won't unless the deal is insane, really good, and the refinance is really tricky, which is you should get paid for because refinancing is not easy. And then there's a disposition fee as well. So if you sell the property, maybe you successfully have sold, you hit your metrics, you sold the property, you should be entitled to maybe a disposition fee as well, because putting together that package, selling is very challenging as well. I have yet to go through it by myself. I've done it with the team, and it is very challenging and stressful. Let's recap how the general partner gets paid. The general partner will first get an acquisition fee, usually 0 to 5%. Make sure it's realistic. Then they get an asset management fee, typically if they're going to be managing the property. They're the asset managers. They get anywhere from 0 to 2%, maybe even a little bit more, depending on the project and the team. Then they can have a capital event fee or like a refinance fee, where perhaps they're getting paid to put together the refinance and make sure it's all goes smooth and gets the highest valuation possible, pulls out money, gets to return money to their investors. They might get a small fee for that as well, 1% or so of the refinance amount. And then there's a disposition fee, the sale amount, anywhere from 0 to 2% as well is acceptable. However, my fees, me personally, is basically just collecting an acquisition fee rather, upfront to roll some money into the deal and to not get paid. I don't get paid, guys, as a general partner. I work my butt off day in and day out, 7 days a week. You got to see how hard I'm working on this, and I don't get paid. And I have a lot of expenses that I have in the background that I need to maintain my business. So I am basically just floating. But any money that I get, I put as much of that as possible into the deal because I believe in the deals as well. Now, putting my money into the deal also makes me a limited partner. So you're going to get paid either as a general partner or a limited partner or both. So I get paid as a general partner as well as a limited partner. How does a limited partner get paid? Easy. The limited partner invests their capital similar to investing in a stock, let's say, but completely different. I don't want to relate it to that, but investing in a security where you're going to invest in something that is going to pay you a return, a dividend, a monthly amount, a quarterly amount of money based on the amount of money that you put in. Let's say I have $100,000 that I have invested into a deal, and that deal is giving me an 8% preferred return. So let's do that calculation. And we're going to get paid monthly. 100,000 times 0.08, 8% preferred return is $8,000 divided by 12. It is $667,000 a month. Sorry, $667 a month. Decent, great return. So your $100,000 is not sitting in the bank. It is gaining interest. It is winning. It is holding its value because you're investing in a hard asset, beating inflation. That is now an 8% return. You're getting $670, $67 a month. Pretty epic. So as a limited partner, you don't get any fees for investing in the deal. You don't get any kudos or bonuses for investing in the deal. For the most part, there are ways to do that, but I'm not going to get into that. But generally, as a limited partner, you put your capital to work in a syndication and you earn a return. And that return, that preferred return of 8%, let's say, it's typical now to be anywhere from 6, 7%. Back in the day, it was 8%. That preferred return of an 8% goes all to the limited partnership side. the general partners do not participate in that 8% preferred return. Okay. They only participate if they are limited partners, meaning upfront with my acquisition fee. Let's say I got $100,000. I rolled that right into the limited partnership side. Now I have $100,000 on the limited partnership side invested as a limited partner, gaining that 8% preferred return before me as a manager can touch anything. If that makes sense, shout out loud, scream at the top of your lungs. This makes sense and I love it. So, as a limited partner, you can put your money in and you're going to get a return on that capital. That's really all that it is. You get a return, but you are entitled to that return prior to the management seeing any return. So it's not a guarantee, but it's a really good hedge against any downside. Although there is always risk and always downside. So please look into it yourself. Now, this also leads to me to backtrack a little bit because I forgot that the general partner will also get paid if they beat that 8% preferred return, which incentivizes the general partnership team to work their butt off to beat that 8% preferred return. Now, there will typically be a split. Let's say the general partnership team outlines the deal saying, hey, we're going to give everybody an 8% preferred return for putting their money into this deal. And if we beat that 8% preferred return, we're going to go to a 70-30 split. We're going to go to a 50-50 split for the money thereafter. However it is, and sometimes there's what's called a waterfall structure where it's like you hit 8%, it goes to 70-30. Maybe you hit a 10% preferred return, and now you're going to 50-50. Maybe it's a 12% preferred return. You hit that metric, and it's 70-30 flip-flopped, where the general partnership team gets 70%, the limited partners get 30%, etc. So know the waterfall structure of the deal that you're getting into. Know that you can get paid on the general partnership side as well as on the limited partnership side, either or both of them. Guys, if you ever have any questions, you need to reach out to me, Nico Antonio Alfredo Salgado. I am your go-to guy. Call me, hit me up. I love you. All right, and that's a wrap, Small Axe community. So I wanted to take a minute to say thank you so much for listening to the show. And if you liked it or got any value from it, it would really mean the world to me if you would share it with someone else and write a review. Remember, guys, keep sharpening those axes. Let's get out there. Let's crush it. Love you guys.